Hey there, and welcome. You know, every company out there has a story, but it's not written in words. It's a financial biography written in numbers. But how on earth do you read it? Well, today, we're going to put on our detective hats and learn exactly how to decode these stories to see what's really going on inside a business. And it all kicks off with one big question.
Yeah, that's really the million-dollar question, isn't it? Is a company a massive success story, or is it just really good at hiding its problems? The truth is, the clues are all there, kind of hidden in plain sight. We just need to know the secret to decoding them.
So, where does an investigation like this even begin? Well, it all starts with what you could call the company's report card. Think of it like a regular health checkup that shows its true financial condition, warts and all.
And these report cards, our primary clues, are called financial statements. You can think of them as the official, standardized story that every public company is required to tell. They're specifically designed to give everyone, from huge investors all the way down to you and me, a clear picture of what's happening with the money.
Now, there are a few different types of these statements, but for our investigation, we're going to focus on the two big ones, the balance sheet and the income statement. Seriously, if you can get a handle on these two, you can understand the basics of pretty much any business. Okay, to make this super simple, let's use a great analogy. Let's think of one of these statements as a single snapshot in time, and the other one as a movie that shows what happened over a period. Let's break that down. All right, first up, we've got the balance sheet. This is our snapshot. It literally freezes a single moment, usually the very last day of a quarter or a year, and it shows you the company's exact financial position. And it all boils down to this one really simple but powerful equation. Everything the company owns, its assets, has to perfectly balance with everything it owes, its liabilities, plus the value that belongs to the owners, which is called equity. Okay, let's make this real. Check this out. We've got our own little business here. Example, Coffee Co. Over on the left, you see its assets. It's got a $5,000 espresso machine and $500 in cash for a total of $5,500. Now look at the right side. It has a $4,000 loan for that machine. That's a liability. And the owner's original investment of $1,500. And what do you know? It balances perfectly. That's the equation in action. So what's the big takeaway here? Well, look, the company's assets are greater than its direct debts. That owner's equity is a positive number, which is a fantastic sign of a healthy start. All right, on to our second big clue. Remember how the balance sheet was a snapshot? Well, the income statement, that's the movie. It shows the financial story over a stretch of time, a month, a quarter, a whole year, and it answers the most important question of all. Did the company actually make any money? And hey, we're back at our favorite little coffee shop. This is their income statement for last month. You see, they made $3,000 from selling coffee. That's their revenue. But it cost them $2,000 for coffee beans and to pay their barista. Those are their expenses. You subtract the expenses from the revenue and you get their net income, or their profit, a cool $1,000. That's the story of their month, right there. Okay, so now we know how to read the clues, right? But why does this even matter? Well, it matters because this knowledge is the absolute foundation of making smart financial decisions. This is the line in the sand, you know? It's what separates smart investing from just gambling. And believe me, the difference is night and day. See, investing is all about doing your homework, about understanding that story we've been talking about. It's about managing risk so you can grow your wealth over the long term. Gambling? That's just a game of chance. It's all about a short-term thrill, and it usually comes with a very high chance of losing your money. We are here to be investors. This quote right here really hits the nail on the head. The pros don't guess, they do the research. Now look, you might not have a whole team of Wall Street analysts on speed dial, but just understanding the basics we're covering today gives you a huge advantage. It puts you in that same analytical mindset. All right, this brings us to what is maybe the single most important rule in all of finance. It controls every single investment decision you will ever make. I like to think of it as financial gravity. You just can't escape it. And here it is, plain and simple. If you want the chance to earn a higher return on your money, you absolutely have to be willing to accept a higher level of risk. There's no such thing as a high-return, low-risk investment. It does not exist, period. And this chart, it lays it all out for us, using over 100 years of data from the US market. It's pretty amazing. So just imagine these bars growing as I talk. First, you've got cash, a pretty low 4.2% average return, but with almost no risk. Next up, Bonds, you get a little bit more return at 4.9%, but you also have to take on more risk. And then you have equities or stocks, a really powerful 9.7% average annual return. But, and this is the key part, it comes with a much, much higher risk level of 19.7%. Higher return always comes with higher risk. So you might be asking, why? Why are stocks so much riskier? Well, it's because their value is tied directly to that movie we talked about, the income statement. When a company is making a lot of money and the economy is doing great, stock prices can shoot up. But if profits fall or the economy takes a hit, so can the stock. That up and down volatility is the risk you take for the chance at those bigger rewards. So the big question is, how do we actually put all this together? How do we use these detective skills and our new understanding of risk to build a real strategy for our own lives? Well, it's all about playing the long game. This is something experts call the investment life cycle, and it's really all about how your strategies should change as you get older. So when you're young, say in your 20s and 30s, you're in the growth phase. Time is on your side so you can take on more risk, like with stocks, to aim for higher returns. Then, in middle age, you move into the consolidation phase. Here, you start to balance things out, protecting the money you've made while still looking for some growth. And finally, as you get closer to retirement, you enter the income phase, where the whole goal shifts to having your investments provide you with a steady income. The key takeaway is that your strategy has to evolve right along with your life.
All right, so let's do a quick recap of everything we've uncovered today. We learned that financial statements are how you read a company's true story. We know the balance sheet is that snapshot in time, and the income statement is the movie. We figured out that investing is a skill based on analysis, not just a game of chance. We've accepted the iron law of finance. More return always means more risk. And finally, we know that our own financial strategy needs to adapt as we move through life.
The bottom line is, you now have the basic tools of a financial detective. You know how to look past the flashy headlines and read the real story that's written in the numbers. So really, the only question left is, which story will you decide to read first?